For those that didn't hear my introduction earlier today, or the one that I just did, I'm Kim Elena Ionescu, the SCA's Chief Sustainability and Knowledge Development Officer. I'm delighted to be joined for our third session today by Tommaso Ferretti, who's Assistant Professor of International Business at the Telfer School of Management, University of Ottawa. His research lies at the nexus of sustainability, innovation, and financialization in global value chains, with an emphasis on impact investing in the coffee sector. Tommaso has worked as a consultant at the International Trade Center and in Geneva, Switzerland, with the World Trade Organization, and he co-authored the ITC Coffee Guide, which is a resource we talked about last year at the Green Coffee Summit because it was just on the cusp of publication. I got to know Tommaso through his work on that coffee guide, and it was only in preparing for this event that I discovered some of the other research that he's done and the topics he's written about, including the one that we're here to talk about today, impact investing. I will admit that I've always been a little bit skeptical about the impact part of impact investing, but I also recognize that that's probably unfair given that I don't know that much about it. So I'm looking forward to learning, and I'll be taking notes so that I can ask good questions at the end of the presentation. I hope you all will bring your questions too. So Tommaso, welcome and take it away.
Thank you very much, Kim. It's a pleasure to be here. Thanks for the nice introduction. And yeah, as you're saying, there is a lot that we don't know about impact investing yet. It's a relatively new phenomenon, a lot of dark sides, but also a lot of big potential. Also, and especially for the coffee sector. So my goal today is really trying to contribute to help you understanding a bit more of what's going on behind this big buzzword that is becoming impact investing. So let's try to collaborate, be together today to define what impact investing is, what are the multiple models that are in place, and how this can play out in so many different ways to improve the sustainability and the competitiveness of organizations operating in coffee at all stages of the global value chains for coffee. So today's agenda, and please feel free to, at any point in time, present your questions in the chat, is to start by a definition of impact investing, putting the phenomenon in context, understanding why it is more and more relevant every day. A second section, the larger section of this presentation, will be about impact investing in coffee. So why it matters, especially for producers, organizations, and processors. What are the challenges to deploy impact investments? As we will see, there are challenges for the impact investors and many challenges for organizations, industry actors working in coffee to really find out where these impact investing are coming from, how they can access them, and what impact investing allows them to pursue. And finally, we will try to focus on a couple of interesting case studies, which are, I think, good examples of the many options that are available for delivering sustainability impact through financing in coffee. At the end, I will try to leave as much time as possible for any question, comments, answers, and as well an overview of some critical industry players that you might be interested in knowing more about. So without further wait, let's go with the definition of the phenomenon. I'm bringing to you today two essential definitions of impact investing. In part, they overlap. In part, they show us how there are different perspectives from which we can look at impact investing. The first definition is coming from the OECD, so an intergovernmental organization, which is a bit of an expression of the attempt to create sustainable development and pursue sustainability. The OECD defines impact investing as a way to provide finance to organizations that address social and/or environmental needs with an explicit expectations of generating measurable social and financial return to foster economic development while achieving social outcomes towards the sustainable development goals. So here I would just like you to highlight make draw your attention on two aspects. The first one is the measurability component. So impact investment are financial investments that want to create the sustainability outcome, but this sustainability outcome must be concrete, must be material, must be something that we can touch, measure, and report. This is the big challenge with impact investing, and this is why often a lot of people don't trust much impact investing as a broad concept, because rightfully so, they ask, is it true that we can generate and measure that outcome? How is that happening? Are organizations reporting real outcome? And then interestingly, these definition link impact investing directly to the sustainable development goals. So to this shared broad agenda of achieving more sustainability. The second definition, which complements this one, is coming from the GIN. The GIN is the Global Impact Investing Network. It's basically an industry association. Is bringing together all impact investing, try to create a network in order to advance the standards and the best practices for this new industry. Their definition is in part overlapping the one from the OECD. They refer to impact investments as investment that wants to create positive, measurable social and environmental impact alongside financial returns. So this proactive effort to create sustainability through financing, but also this idea of the measurability of the outcomes you generate are central also in the GIN definition. In addition, here, there is a bit more of an impact investor perspective, if you want, to the definition of the phenomenon. In fact, they underline the idea that there is a spectrum of options when it comes to generating profit. There are impact investments that only focus on generating financial returns at competitive rates, others that instead adjust their market rate for profit to the sustainability risk of generating impact, meaning they're ready to accept lower than the market rate profits and returns if you're able then to produce more sustainability outcomes. And this leads us to the different model that we often label as impact investment that are available in the market. So this is a nice model that I took from the Global Outlook on Financing Sustainable Development. Is an OECD publication. And you can see how there are multiple type of so-called sustainable financing / impact investment. It's important to differentiate about these things. There are different things, although they try to serve the same purpose, which is generating sustainability through finance. And so from the left, you can see there are the so-called responsible sustainable investing, the so-called ESG funds or the portfolio screening. Here, it's basically when you go yourself at the bank to visit your financial advisor to take care of your own investments, and you're told by the financial advisor, okay, let's try to invest, but let's eliminate investments into stock market titles that are referring to gas producers or to fossil fuels companies. Let's try to focus only on investing on companies that generate a positive impact or do not affect the natural environment or society through their operations. So this is a bit of an extreme in terms of not being hands-on on the problems, the sustainability issues that we try to address. Moving to the right, we see how there is the so-called impact investing return first, for example, green bonds or impact private equity or impact venture capital. These are financial investments that try to target organizations such as social enterprises that are generating sustainability outcomes. However, the profit, the return, the idea of generating financial returns at market rates is still prevalent. Impact is less of a priority, although it's present and complement the definition of the product. Then there is what we will focus more today on, because it's what is most relevant to directly address sustainability issues in coffee, which is the impact investing impact first. So those financial tools that are prioritizing the generation of social and environmental outcome, such as outcomes-driven loans. So loans that are granted to firms, to producers' organizations, to social enterprises, subordinated at the generation of social and environmental returns that are measurable. And then we move more towards the right of the model to philanthropy, and so donations, seed capital donations, and other type of models, which, however, lose a bit of the profit return and focus more on a donation, on a philanthropy approach to development, which is very different, as it lose in part the market sustainability aspect. Now, before going on, let's also understand that this wave of products, this increased talking about impact investment, is due to a key central challenge to achieve more sustainability in general at the world level, which is the big financing gap, especially in emerging markets. The UN has calculated that we would need 2.5 trillion annual investment in emerging markets to really be able to achieve the SDGs by 2030, as planned in the Sustainable Development Goal agenda. Despite of this huge gap, it's only 20% of the global financial investments that reach firms in emerging markets. So there is the need to expand, to create more opportunities for financing to target firms in emerging markets, firms operating in agricultural commodities in particular. This is why impact investing is becoming more and more relevant, and a lot of organizations are trying to push this phenomenon forward. Now, before advancing further, also, it's important, I think, that we do a little recap, and you can already think, if you have any question already at this point, please feel free to jump in and write it down. We'll try to collect already something we can answer now, some we can answer later. But to be all on the same page for the rest of the presentation, so we will refer to impact investor or any type of financial institution that is deploying the investment. So this can be an investment fund, as we just saw. It can be a non-profit organization that receive funding from some donors and then channel it to enterprises in the field in the form of loans. Or it can be a microfinance organization, or it can be a foundation that is administering impact loans. Then we have the investees. With investees, we will refer to the cooperatives or the small and medium enterprises or the social enterprises in the coffee global value chains receiving investments. For global value chains, what I refer to this idea that the way in which we reach the final product, in our case, our cup of coffee that consumers get at the retail position, you need a whole set of production and trade operations which are fragmented. And so you have the producers organizations, you have intermediaries, traders, importers and exporters. I guess that most of you in the audience know very well what I'm talking about. So I'm referring as global value chain to these fragmented stages of production where different organizations perform different functions in order to get to our final cup of coffee. I will also talk about supply side and demand side of the impact investing market. Supply side referring to the whole of the impact investors, and demand side referring to all of the investees needing more finance. Now, about impact investing, so we define it in general terms as a big new phenomenon. What do we know about impact investing? First, in agro-industrial global value chain, so in sectors such as coffee, cocoa, coconuts, bananas. And this is an important perspective because we know that a lot of, for example, producer organizations do not only produce coffee, they also produce other goods and food-related ingredients that can be leveraged for market growth and competitiveness. So in general, impact investing is a business on the rise in agriculture. There are a lot of opportunities for investors whose mission is not just to create financial returns, but also sustainability returns, to engage with the Sustainable Development Goals when working with agricultural organizations and value chains. So by partnering with big roasters and their exporters, importers, producers, and so on, you have the opportunity to link up to a lot of production activities that directly affect biodiversity, soil conservation, water management, income generation for poor communities, and so on. In addition, a lot of impact investors will tell you that cooperatives and small and medium enterprises represent attractive targets for impact investment, not just for the potential link to the creation of sustainability returns, but also because of the long-term trends in agribusiness, which are usually characterized by growing food prices and expanding markets. Although, of course, we could debate a lot in relation to these with the issues related to food price volatility. And in fact, the other side of the coin here is that is in a business on the rise, impact investing in agricultural global value chains, but also very risky from an investor perspective. A lot of investors, not necessarily by grounding their decision or their thought on data, but more because of a bit of an entrenched distrust for agriculture, believe that most organizations do not have the capability to manage credit and loans. Therefore, they are a bit more titubant in investing in SMEs and processors in coffee, in cocoa, fruits and vegetables. Plus, they are often scared away by the context in which most agricultural organizations work in developing countries, in emerging markets. So contexts where there is a higher likelihood than in the West of political instability, economic crisis, natural catastrophes, plus all the traditional issues that can affect the profitability of investing in agriculture, in particular pest and disease outbreaks that in the past have really affected a lot the coffee sector. Finally, there are external factors such as food price volatility that affects the long-term investability of this sector. This, of course, is the perspective from impact investors. What is interesting is also to notice this is a survey that was recently developed by IRIS. This is an entity connected to the Global Impact Investment Network, the GIN. They were basically surveying impact investors. They looked at the sectors in which they most operate, which are agriculture, energy, financial services, and health. And according to their answers, agriculture is the sector where potentially you have among the lowest net profit margins, and in particular where there is the higher risk for the impact investors to do not produce any return at all, rather having more costs than anything. So there is an essential problem for growing further impact investing and the supply of impact investments in agriculture, which is the risk perception and the real risk that impact investors encounter when approaching agriculture. But let's talk now about how these aspects plays out specifically in the coffee sector, which is what we're most interested in. Coffee, this is very interesting, is a privileged investment target for impact investor. So this is again the same survey from the previous slide. And here they show the impact investors report coffee as being by far the commodity which attracts most of their investments. Why is this? Multiple justifications, possibly. The key one, I'd say, based on what investors told me in my work, is that coffee is perceived as a very well advanced industry from the perspective of the so-called sustainability infrastructure. Because of all the many sustainability standards at play, the many CSR, corporate social responsibility initiatives of multinational corporations, the involvement of international agencies in providing development, there has been more efforts and more facility in setting up, for example, a lot of indicators to track and measure the achievement of sustainability outcomes. So both social outcomes, like increasing the revenues or the education or reducing child labor in the community where we produce coffee, and environmental indicators like increasing biodiversity, soil preservation, water management. All of these aspects are already very clear in the coffee industry, much more than in other industries such as coconuts or some vegetables or seeds related industries. So coffee in this sense has a competitive advantage in attracting impact investments. This is something that operators in the industry needs to keep in mind. And impact investors know quite well the coffee industry compared to other agricultural industries. So there is a competitive advantage if you are a coffee organization compared to other crops in interacting with impact investors. The key thing with impact investing is that impact investing can generate a change in the way we finance production, the production of coffee. This is a table that we developed for the ITC Coffee Guide, which Kim was talking about early on. This is very interesting because it's a result of inputs from industry stakeholders. So it wasn't me and the other co-authors at ITC and other organizations that sit down and develop the tables. This was drawing from inputs from representative of the producers, of the processors, of the traders, the roasters, trying to understand, okay, where is the financing of the coffee global value chain coming from? And so there are multiple options, and especially when we look at the processing and the production stages of the value chain. And so how smallholder producers and agricultural SMEs or producer organizations, cooperatives get their financing. The key providers are usually commercial banks external to the value chain, or the buyers. It can be intermediaries, traders, it can be the importer, the exporter working for a big multinational corporation that is a roaster or retailer. So we have multiple options here. However, there are some issues related to this financing. The issues are that, and again, I'm building on what has been reported by the industry stakeholders in the process of developing the coffee guide. There are some priorities for coffee production which usually remain unaddressed by the current financing. In particular, we have crop renovation, we have R&D, especially for developing new coffee varieties, for example, climate change resilient varieties. There is issues in financing solutions to labor shortages. Working capital tends to be too expensive when financed through local commercial banks or buyer's credit. There is the cost of sustainability compliance. A lot of producers' organizations or processors, they're trying to achieve standards like organic or other voluntary sustainability standards, developing the practices, agricultural practices, processing practices, managerial practices to achieve the sustainability standard and maintain it. It can be very costly. And not always the buyers or the local banks will provide you with the financing to do so. So there are these set of issues which impact investing can help addressing by providing an alternative source of financing, which is more sustainable for the global value chains operators. Now, to sorry about this, to give you a bit more of an overview of these solutions and issues, I will build on my research, okay? I will try to go through this briefly. Basically, I did an investigation about 63 coffee SMEs. So we're talking about large cooperatives, first or second level cooperatives, producers organization and processors based in multiple countries in Central and South America. All were seeking access to impact investments through an intermediary organization, and or engaging with sustainable production. So all these SMEs were certified with at least one certification, or trying to achieve their first certification, but trying to access the funding to do so. Now, what is interesting is that all of these organizations accessed and financed their production in the past through financing coming 90% from their buyers, what I refer to as global value chain financing. This was short-term loans, 6 to 12 months for the repayment, so usually just to finance the seasonal production, with a very costly interest rate. 32% is the average of the loans that the 63 SMEs reported to me in the data. Plus, this financing was only to fund the harvesting and working capital for that season production. Instead, impact investors offered these organizations, I'm talking of a sample of 15 different impact investors that interacted with the organization in my sample, offered longer-term working capital, up to 36 months for the repayment, even up to 72 months, so very long-term capital, when it comes to machineries and equipment, infrastructure, capacity building. So from the build-up of a storage facility to hiring the trainers and the capacity building experts to develop new competencies at the cooperative level or at the processing level, both in industrial and on-farm processing. And of course, the key element here, the average interest rate for repayment, just 12%, almost 1/3 of what global value chain financing from the buyers will guarantee. So my finding here is that really that global value chain financing, the credit through which we usually in coffee finance production, do not fund a lot of projects that coffee organization would like to implement and need to become more sustainable. Related to this, this is a complex slide. I want to call your attention just on two elements. This is a categorization of the strategies of the companies that I studied in my research. I identified three key categories: breakout, breakthrough, breakaway, based on how advanced these companies were in trying to become more sustainable, meaning for more sustainable, producing according to sustainable standards, but also achieving increased revenues for the local community and for the members of the organizations, and accessing higher quality, niche qualities for their products. So despite of all the differences in their strategies and the issues that these three set of organizations faced, all of them had a key issue, which was their financing. All of them, they reported, look, we get bad financing from our intermediaries, from our buyers, from our service providers. What we need to do is to shift to more sustainable financing. The type of financing we just saw in the previous slide, where we deal with lower interest rates for repayments and longer term, and also financing other type of initiatives. However, there is a bottleneck to accessing this financing. There is a learning challenge. So when I went and checked how these 63 companies performed when trying to apply for impact investments, I can see that across the three categories, from the breakout through the breakaway, you had very high rejection rates. So roughly 60% for breakout and breakthrough SMEs, which are companies that are still trying to diversify their market channels, foreign market channels and sustainable product channels. 40% even for breakaway SMEs, which are SMEs that are already producing under a regime of multiple certifications and that are already working with multiple foreign buyers in Europe and North America. So the problem here is that all of these SMEs, despite of their sustainability needs, despite of their attempt to access better financing, they clash against this lack of capacity to comply with the requirements of the impact investors. And what are those requirements? I would say I capture 4 organizational capabilities. So let's say areas of knowledge within the firm that the organization should develop. Very briefly, 4 categories, I'd say: the financial practices, so basic accounting practices, financial literacy, financial risk management. All of these dimensions in most coffee organizations that I studied were absent or still too weak for the impact investors to feel safe at investing in these organizations. A second comparable aspect is the one of auditing. The impact investors I studied were requesting audited financial statements and commercial history from the organizations. Lack of capacity of providing audited documentation was considered a challenge. But as many of you probably know, it's an issue for many producing organizations and processors in Africa, in Asia, in Central America to develop this type of capacity. Same goes for business planning. The impact investors in my sample were all requiring the SMEs to apply for an investment by presenting a very sound and coherent business plan, structuring objective, long-term goals, where they're saying, okay, we're going to use the investment to achieve this, this, and that, and this is how those different projects and activities will allow us to increase our revenues, therefore repay the loan, but also generate all of these sustainability outcomes that we want to measure. And finally, there was a lack of competencies in terms of having a formalized market. A lot of organizations were still working both with the conventional product, often through informal contracts, as well as sustainable certified product with formal contracts. This was an issue for impact investors, requiring the formal contracts as a collateral. So what happens is that the organizations need to build these capabilities, and still, despite assistance that, for example, NGOs or international agencies can provide, as in the case of these financial fairs that you can see the result in this fair, a lot of organizations still can't access the investments. So these are data from another bunch of enterprises which try to access financial impact investments after receiving training in the areas of business planning, financial literacy, and so on. Still, out of a total of 140 loan negotiation between the SMEs and the impact investors, 91.4% of the so-called matching, so attempts to link the SME to the investors, failed. Why they failed? Because it's not just about the capacity of the organizations. There is another side of the coin, which is a lack of capacity by the impact investors to adapt, to tailor their products to the needs and the challenges of the enterprises. So it's not just the enterprises needing to learn more, it's also about the impact investors needing to do better. In particular, if a lot of organizations have a lot of debt from previous years, how they can compete for impact investments? They need to receive additional support, also in terms of financing, or the impact investors need to adapt the product to their needs. This is not always possible. The same goes for the explanation of the requirements of the impact investors. A lot of SMEs didn't receive a clear enough set of requirements from the investors. A lot of time the investors do not fully understand the coffee model for business, so they do not trust investing in long-term activities. So the truth is, there is more need of learning, both for the SMEs on the demand side and the impact investors of the supply side. And to do this, you need collaborations and you need better models for impact investing. And this is what leads me to the following segment of the presentation. So what type of approaches we could think about to better match the supply and demand of impact investing in coffee? I will go briefly through three models, which are either show successful or are very promising in trying to change this dimension of impact investing. The first model, most of you probably know Root Capital. Root Capital has been one of the pioneers of impact investing in coffee. These are information that are just reporting basically from their official reporting. And this is a model that is very interesting. Is the so-called, they call it the SIIMS model. And basically what happens here is that Root Capital, which in this graph is the green tree here, is providing lending and advisory services to an enterprise. It can be a large cooperative, it can be more of a social enterprise service providers, which in turn links to the community of farmers and producers organizations. The loan is a so-called outcome-based funding instrument. So it's an instrument, is a loan that is given upon the generation of sustainability outcomes that are measured. The key game changer for this type of model is that you have two outcome payers. The IDB Innovation Lab is an office of the Inter-American Development Bank, and the Swiss Agency for Development and Cooperations. What do? They provide additional funding to Root Capital, which then channel it to the enterprise, as a way of compensating the additional risk in which Root Capital incur by investing in early stage coffee businesses. So one typical problem of impact investing is the impact investor coming in the field, looking at all the landscape of enterprises, cooperatives, processors, exporters, and investing in those that are already well established, in those that they already show profitability in their model and ability to produce and generate sustainability outcomes. That's not enough for the scalability of the model. You need to be able to expand the spectrum of actors, of investees that you can reach. What about those rural organizations that are more disconnected from markets, from support organizations in the field that only receive little support from the extension officers of the Ministry of Agriculture? You need to go to them. This is more risky, is more expensive. And so through these outcome payers that are paying upon the generation of sustainability outcomes, you reduce the risk for the impact investors, and you have a model where you're able to reach out to a larger number of enterprises and cooperatives, for example. And a key central element, of course, in this model is impact measurement. So you have this independent verification system where an organization, Roots of Impact, just take care of measuring and assessing the generation of social outcomes at the farmer level and to report it to the outcome payers so that you can create this virtuous circle of generating payment to reduce risk for impact investing in early stage businesses. A second model that I want to present to you very briefly, this is really a new initiative, okay? While the previous initiative by Root Capital is a model that is already well established and target directly the producers, here is more of a high level stage. So if you remember the table that I showed in a few slides before, where we look at how the global value chain is financed, you can see that at the processors and roasters level, usually we operate still through traditional trade financing. Here we have instead Mondial, which is a Swiss impact investor, partnering with USAID, Rainforest Alliance, Conservation International, and CDP, in order to create a platform, basically, to convey actors, including the big roasters and retailers, and to convey more, mobilizing more financial resources for generating projects that prioritize biodiversity and climate change resilience in coffee and other crops in order to advance in the Sustainable Development Goals agenda. So here, it's really about an evolution, if you want, of the traditional multi-stakeholder platforms bringing in industry actors, because it really has a strong focus on new financing mechanism. So it is about designing, launching new financial investment funds, which only invest in initiatives within the global value chain of the actors that will participate and join this platform, as long as these projects generate some specific sustainability outcomes. Okay, I see that there is a question that I want to address already from Andres Montenegro. He was asking how to close the gap on patient impact investment that is frequently needed but harder to access for smallholder farmers and producer organizations. Well, this is an excellent question, Andres. In fact, this is a bit what some of these models are trying to do, right? So with patient impact investments or patient capital, we refer to this need by the organizations to have multiple years, at least, before creating the increase in revenues that is needed to repay the loan. As you know, sustainability requires long-term perspective. So if we think about projects like reforestating a production area and crop renovation, that takes years before becoming productive. So how you get this to become profitable for the impact investors? Through organizing a sort of safety net that de-risk the investment. And this is usually achieved through either partnerships or by integrating private and public financing. So in the previous example, Root Capital, what they did, partnering with the outcome payers, they link up additional funding from public sources that are more inclined to pay long-term funding, linking the payment of the funding to the creation of sustainability outcomes, and so blending the funding that is coming directly from Root Capital with the outcome payers funding. This way you have a mix that is able to hold for a longer time and be more patient. In this case, it will be up to Mondial to develop the new financing mechanisms that are linked to participation in markets. Here comes, for example, the partnership with Rainforest. This is again a project that was just announced this summer, so it's in the making, but it's interesting for me to draw your attention on this because it might grow in the future and you might heard about it again. And then another way, Andres, to get to this gap reduction for patient capital is the other model that I'm going to talk briefly about. This is also a model in the making, is called a holistic approach. It's being implemented by Listenbessler, the Hamburg-based in Germany coffee importer, in partnership with the International Trade Center, Alliances for Action. Basically, what Listenbessler is doing is to insist on the creation of farming accelerators in the production areas, where there is a holistic approach to sustainability. So there is both reducing CO2 emission, creating a bit of a business incubator model to create more managerial capacity and more competencies and shift into sustainable practices. There is the social component of the business involved, so how you deal with the community, and there is the goal of improving the farmer livelihoods. How do you get there, however? This would be just an individual project, as many of you have seen already. The game changer here is to link it to global value chain partnerships, where you bring in all representatives of the chain to generate and attract some more impact investing in order to finance the intervention at the farm level. And so the impact investors collaborating with Listenbessler, in this case, the project developer, and organizations in the field, in the producing countries, collaborating to train producers and their communities to improve their different aspects of their production. Plus, there is also on the contrary way, the farmer accessing more green trade financing in order to be able to develop more sustainable practices, collaborating with the traders, the farmer groups, the cooperatives, and the exporters until the roasters. So here the idea is that you can reduce the risk for the impact investors and attract them to, I'm really sorry about my cough, and really attract them to invest more in coffee sustainability by relying on this partnership where everybody's represented, where everybody's on board, where you have shared goals and aligned interests, so that the impact investor is coming and say, okay, what if the farmers have issues because there is a disease, pest outbreak in production? No problem. They are collaborating strongly with a local NGO and local government to create better skills. Plus, there is the International Trade Center of the UN that is also bringing in additional partnership for competence development. Plus, the importer and the retailer, Listenbessler and their buyers, are also in for this project that will guarantee for the global value chain profitability in the long term. So if we have issues one year, the following year we will be back on track. So this partnership can operate as a de-riskification factor. In fact, the interesting aspect here is that by creating this shared commitment to adopt sustainable production practices and ensuring scalability and profitability of the trade model in the long term, with this strong emphasis on building more capacity, more technical competences in the firms and in the producers, as well as having in place this, which is of course always fundamental, an efficient and realistic way of measuring your outcome in terms of financial profitability and sustainability outcomes, while these can operate as a de-risking factor. So building on these three experiences, I will just, I'm going to close with the last couple of slides. So first, some key takeaways for today that I'd say we can use as a possible lessons learned is the fact that impact investing has a lot of potential because it can help addressing the sustainability of coffee by changing the way we conceive trade and production financing. Second point is that there are multiple models to do so, but also still a lot of issues. So let's remember that impact investing is still a relatively recent phenomenon. The industry is still evolving. There are also a lot of people jumping on board without really saying what they're doing and with little transparency. But This potential is there. A lot of experimentation is going on, and there are already some clearer ideas than 5 or 10 years ago on how partnering, building alliances in the global value chains can help improving. The third aspect is that you need to build some technical competencies both among the impact investors and the investees, the organizations, the global value chains operators. For investees, it's about improving the chances of accessing the investments through partnerships and with new competencies that are specific. And then the other aspect is having more knowledge in the impact investors about what are the needs of the investees, and also more efforts by the impact investors to reduce, and this is really a cultural, a mindset thing that will change with time, to reduce their expectations in terms of profit, accept maybe a higher risk, or accept to limit their own space of decision by partnering with public actors and other actors. And finally, another aspect is the essential role of collaborations between global value chain actors, financial institutions, and even governments to improve the profitability of impact investing in the future. So with this, I'll just stop on this last slide where I'm trying to put some key actors, private impact investors, non-profit impact investors organizations, and intergovernmental agencies that play a central role in trying to expand the impact investing market in coffee and other agricultural commodities. These are just some examples based on what I saw in my research and in my work with the ITC Alliances for Action of organizations that are doing work in this area. There can be much more than this. And this is it for today, because I wanted to leave some time for questions. There are still about 10 minutes. So it would be great now to have some questions and comments. And I hope that the presentation was interesting enough.
Thank you, Tommaso. That was super interesting. And as I promised I would do, I hope everyone can hear me. I'm not muted this time. As I promised I would do, I did take some notes, and I did end up with some questions, and I know that the audience did too. One thing that I was thinking about, actually even preparing for this session and remembering before I joined the Specialty Coffee Association, when I was a coffee buyer for a sort of smaller company, certainly than many of the ones I think that would be familiar with impact investing, or even some of the challenges that producer organizations faced. I think about that experience, and I wonder whether there's a role for smaller buyers. And I'm thinking about roasters, because as people have introduced themselves in this audience, I've seen a lot of everything: some importers, some exporters, some producers, and also some small roasters. And just wondering if in terms of leverage, is there a way for smaller buyers to exert leverage here? Does it require a lot of coordination? I'm thinking at a level smaller than like List and Weissler, for example. What do you think about that?
Yeah, no, this is a great question. So I think that going forward, there will be more and more space also for smaller roasters to play their role. They are an essential part of the industry. As you mentioned, the issue is coordination there, right? So how do you get to reach the volumes that maybe can be profitable for an impact investor, to address also your participation, your contribution to the sustainability of the chain? To get that, I would say a key aspect is, again, partnerships. How you partner or either multiple roasters or a roaster partnering with multiple actors in their own value chains. It can be also about finding out what other products, financial products, are becoming available. There is more and more innovation going on also from the perspective of the impact investors. More and more product that can become feasible for smaller organizations to shift to a more sustainable form of financing their role in the chain. And so for the roaster, how I can use a greener form of financing my purchasing channels, for example, Another aspect that is relevant is there are also more and more organizations in the realm of the United Nations, the intergovernmental agencies, specialized NGOs that are trying to function as intermediaries between roasters, exporters, importers, traders at the local level, producers organizations, trying to create platforms to link up those actors, develop a common system of measuring the impact and link it to access to investments and financing. So I'd say I won't be, I will be truthful. It's difficult. There are still challenges to enter into this type of financing and system. But I think that there are a lot of margins in the future to grow in this sense and to link to initiatives that are trying to do this properly. And already knowing a bit more of the map of the actors, who does what in impact investing in coffee, can be a starting point to understand what contribution you can develop.
Yeah, that's a great starting point, I think, for everyone. And I'm glad that you showed the slide that you did that had the different interest rates, for example, and, you know, between traditional investing and impact investing. And even I would imagine that for some people, it might be new information to know that I think it was 12% impact investing, may still feel like higher than would be expected. That's not something that I think of many people, especially, companies that are just getting started and just beginning to think about this, on the buying side, being particularly familiar with. And this is one of those realities that everyone, it seems like, even larger companies, but everyone on the sort of production side of coffee is very, very familiar with. So starting to, to recognize some of these realities, I think even if it's going to be difficult for a small buyer to exert a lot of leverage, is something that can be part of a conversation in the context of a trading relationship.
Yeah, and if I can add something on this, let's also consider that also the countries where roasters are based are increasingly trying to develop impact investments programs, looking both at the national and the foreign level. So I'm based in Canada. The Canadian government a couple of years ago created a huge fund for impact investments targeting new social enterprises. So there are funding, also public funding in Canada, probably in the US, in the European Union, for companies like roasters that would like to commit to a different form of organizing their value chains, their supply chain. And those are also options that you could consider, because a roaster can also become, if you want, a service provider, generating sustainability in the chain based on what practices you decide to develop. Of course, for a small roaster, it can be challenging it can be a lot to take on an impact investment loan, having to report it. So again, there a key aspect I'd say is to focus on trying to develop partnerships that can help you navigate those issues. Partnership with actors upstream your chain, your supply chain, and with NGOs or other accelerators or organizations that can have technical competencies to support you in developing a solution, a sustainable solution to your supply chain.
I had one quick question, and then I do want to bring in an audience question, but about that sort of small roaster piece again. I noted when you were talking about the needs that investors have to better understand the supply chain. I appreciated that too. That yes, investees do need to have a basic financial management, and sometimes things are lacking, but also investors often there are things that they don't understand and limitations on the investor side also. And I wonder whether that's something that roasters who are take pride in coffee education, is there any sort of opportunity for is that marketing, is it targeted, is there is that something that the consuming side roles could take on?
Yeah, no, absolutely. It's look, a lot of impact investors, and coffee does much better than other sectors, but a lot of impact investors have sometimes no clue of, so they know the basics of the fundamentals, and there are exceptions, even within the impact investors, Root Capital, for example, or Oiko Credit, or these more non-profit oriented ones have been working with the agricultural sector for decades, so they're more experienced in that. There are other sectors that are entering now the business, and they sometimes prefer to partner with the big roaster because there's already a better knowledge of the system, of the chain, versus the small roaster because they cannot gauge exactly what's the profitability model there. So it's really about trying to develop more fora, more spaces for discussion, for sharing information. Impact investors, small roasters, producers organizations, exporters. At the end of the day, as for anything that then leads to innovation and improvements in sustainability, is about creating a shared knowledge and understanding of what's the problem, what's the business case for solving the problem in a sustainable way, and then developing the common solution, right? So there's starting to be spaces like that, but a lot of times it's also about the entrepreneurial vibe of the roaster or other global value chains operators that can be more or less eager to engage with impact investors and explore solutions potentially together.
Yeah, I appreciate that that reminder on the sort of need for continued innovation and conversation about how it could look different.
Yeah.
And I want to, can I ask one last question? I know we're almost at time, but there was a question in here from Ben about the idea of patient capital, which I think we had a question about that, that you answered without even needing me to host, as an impact investor come into play, especially on expectations on interest or equity when not investing for working capital, but rather for PP&E or CapEx?
Yeah. So to given the small amount of time, I will try to be very brief about this and to generalize. So it really depends from. It changes a lot, impact investor to impact investors, because again, you have the impact investors, so-called impact first, where that are ready to accept a patient capital for not just for working capital, but also for other type of investments, as long as they are supported with a business plan, and as long as there are some form of safety nets for the investment, such as technical assistance on the field and measurement. Some impact investors that are less impact first, that are more careful about their bottom line in terms of profitability, for them the question is a bit, the issue is a bit more complex. What I'd say is that a key element there is relating to the opportunity to also have blended capital solutions, right? And so you can be ready as a profit first impact investor to accept a patient capital solution, also an equity investment in machineries or plant and crop renovation that maybe take 4 or 5 years before showing productivity, when there is the co-participation, for example, of an international agency or a government, which are matching the private investment, the private capital. And so you can reduce the risk and the interest payment overall for the producer, because you have a capital preservation margin for the public part of the blended solution and a higher interest rate from the private component. I hope I've been clear enough, but then I can address anybody that has a question can write me, and I can try to be more precise about that. Later on.
I think that's probably a good, as good a place as any to end in the offer to respond to people's questions. You know, either I can email you, or even if you want to join us in the chat, you know, after your presentation is over, maybe you can respond to a few of the things that have come up and just clarify a couple of the points that people have questions about.
Yeah.
But yeah, so we're coming to the end of the session, and I want to thank you for giving us that overview and putting that whole explanation together. I feel like I definitely have a better sense of impact investing than I did an hour ago, thankfully.
And that was the goal.
Yeah, and for everyone else too, I hope that some of the viewers are inspired to think about how purchasing relationships can be used as leverage, and up there on the production side, how some of these tools may be accessible and may benefit them, or what they might need to do to be ready to pursue them. So thank you.
Thank you.
Yeah.
It was a great opportunity. I hope that everybody in the audience got at least a little something out of the presentation. This is a very complex new phenomenon. I tried to simplify as much as possible to convey a lot of information, and I hope that it helped. It was a pleasure to contribute to the Green Coffee Summit.
Thank you, Tommaso. So as I said at the beginning of the day, it would not be possible for us to do this event or make all of this knowledge freely available in the resource library without the sponsors of the Green Coffee Summit. So we're going to spend a minute or so before we get to the next presentation learning about San Coffee and Mercanta, two of our supporters, and then it'll be time for the final session of the day, in which my colleague Mansi Chakshi, SCA's Regional Community Director for the Americas, will be hosting a panel featuring different perspectives on the North American coffee market. So I'm looking forward to hearing about their experiences and continuing the learning.